Thank you. Thank you, Maverick. That's probably the male. What are you doing, Mav?
Okay, how are you?
Good. Maverick's about to climb on my lap because I'm trying to wind yarn.
Oh my gosh.
What? What are you doing, dog? Hello. Turn around and
There
say hi to
he is.
everybody.
Hi, buddy.
No, not me. Don't kiss me. I don't want kisses. Yuck, 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 yuck. Kiss the. Say hi to the kids. What are you doing? That's enough. Thank you. No, come on. Enough. I don't like that. Enough. Enough. Do you love me? Do you love me? Apparently not.
Aww.
Get down. Where's Daddy? Mommy needs to write down who's here. You Tank, you need a bath. Tinky bug. What do you see? What do you see? Is it a deer? Mama's head won't go that far around. I can't see. Is it a deer? I don't know. Go look in the living room. What is it? What do you see? I don't know what it was, but he went to the other room to figure it out. Okay, I got Ashley. I got Chase. Grant. Did I get Shaylin? No, that's where I got interrupted. Hannah's here. Jen. Jen, were you here the last time?
Me or the other Jen?
Jen
Leash?
Andrus.
Oh.
Sorry. I know you were Jen Lees. She's ignoring me.
The other Jen was there.
She was here.
She was
Yeah,
here?
was.
Okay,
Yeah.
I
She
thought
made
so.
a
I think she got here
saying,
late. Okay.
I'm surprised my kids have left me alone this long.
I remember you saying that. Okay, because I didn't have her marked down, and I still do have to take attendance. Oh, there you are. Here it comes. My current project, and I'm not sure if I like it. I think it's too wide.
At first, I thought it was a Santa Claus beard. I was like, what is she doing?
It's a scarf, but I think it's too wide. So I'll probably rip it out. Okay, Ashley's here. Somebody else just came in. Giantonio, for some reason, is on the bottom. Oh, thank you. I just think it's too wide. It was what I was doing while I was watching Tiger King. It's mindless.
Carol Baskin killed her husband.
I think so. And Jeffrey Epstein didn't kill himself.
Yeah, I can live with the Jeffrey Epstein did not kill himself. Somebody else killed him and framed it like that.
One of my friends finds memes and sends them about that, and it just cracks me up. Ah, crap. I have one more episode to go of Tiger King. And I'm sitting here going, why are you watching this? Why?
That is because everybody is bored because they are inside their house and has nothing else to do but sit around and watch TV and watch some of the dumbest things. That's what I say.
I think you're right. I'm not a TV person, so it's like, why are you watching this?
I don't know. I still have to go to work and crap, so we're not sitting at home watching TV all the time.
No, I usually don't. I'm
Alternatively, on Audible, you can listen to the first Harry Potter book as read by Stephen Fry for free right now. It was only available in Europe until, I guess, last night when they sent the emails out. So do that instead of watching TV.
I usually have been upstairs in my craft room doing stuff, or I'm reading. I'm not a big TV person.
I've just been trying to work ahead in schoolwork.
Good idea.
It's not really working out well for me for most of my classes, but I'm trying.
Yeah, it's a struggle for everybody. And I see everybody complaining about the no professors assigned to things, and I'm thinking, yeah, we're not real happy about it either.
My thing is we were told that we were allowed to apply for accounting 160 and accounting 161 in the same term, and it won't let us.
Oh.
It tells us that we have to have 160 done first. Well, if it's a 7-week course, we should be able to do both of them at the same time.
Yeah.
But
okay, I just read Giantonio's message. I'm seeing, because there's that Facebook group, that a lot of people are having problems with registering, and people are not happy that there's nobody assigned to stuff, and it's because they're trying their best.
Yeah, I need an advising code, and my advisor told me I wouldn't need it. So that's neat.
Yeah.
How many credits do you have, Christina?
No, this is my first semester, but
Gotcha.
I had an appointment with her last month, and she said, okay, well, I have everything set up and it's approved, so you shouldn't need an advising code.
And you still do?
Yes. So I was up at midnight thinking, I'm going to nab these
register
classes I want.
Yes.
And I was pretty upset. So
reach out to them today.
I did. I sent an email last night, but then I realized I might not have sent it to the right thing, so I sent it again this afternoon. And
they're all so overwhelmed.
Yeah.
And I'm noticing, and not with you guys, but I'm noticing in that group, there's a prevailing attitude of, I'm the only one who's having a problem and it's all about me.
Well, yeah, everyone's self-entitled, and
Right.
they're the most important person in their lives.
The accounting 200 is only offered online.
Mm-hmm. And I don't know who's teaching it. Does it have anybody assigned to it?
No.
And they will have no other online. They will not have any accounting not online.
Probably not. The whole accounting thing is changing. It's your course, the 101, is going to become 2 courses. I think it's 150 and 151 or something like that. And then 200 is what, the 160s?
Yeah, accounting 200 will be 160 and 161.
Okay. Because they're making them now 7-week courses. So this course would be, separated into 2. And you'd have to, I guess you have to take one before you can take the second part. But I think if you take, I was so confused when they were telling me. I was like, what? It was like you could take the first half of 101 and then take the first half of 200 to follow, which didn't make, I don't know, I could be wrong. Yeah, it didn't make any sense to me either. It was like, you've got to have this stuff to get into that stuff. But I don't know. And they're not using your textbook. So if you can take it over the summer, then do it, because it won't be the same textbook in the fall. And it won't be the same. Apparently it still transfers as the 2 separate things. If you're taking it over the summer, I have that book. I have the Accounting 200 book, and I have the solutions and everything manual. And I can get into Pearson and set up a practice course for me, not for you. But if you need help, just reach out.
Are you going to teach any online courses?
Not 200. They don't usually let me. And I have no idea. I don't know. I had a summer course assigned, but then they canceled. They changed everything. They took everybody out of the summer courses and they're redoing everything because they don't know if they're going back on campus in May. That nobody knows what's going on. And it's
do this because I like to stick to one teacher if we have to if we have additional classes because
right.
I know how you teach and I don't want to get used to another.
Mm-hmm.
It's just ridiculous.
I've brought that up and it falls on deaf ears. But yeah, that's Adriana just said that they will be 2 credits instead of 4. So I'm assuming that they won't charge you as much either. But I haven't even gotten a book. I haven't gotten any notification of, no, take that to Daddy. He has a toy. Any of how we're even supposed to teach it. And all of that was in the pipeline, but then this happened.
They're not double charging us. They're charging us for the credits. So,
that's what I
for
thought.
instance, this class is 4 credits. We're being charged for 4 credits. So if you take accounting 150, you're being charged for 2 credits.
Right.
And then if you take the next one, we'll say that's 151. You'll be charged for another 2 credits. They're not going to charge you for 8 credits because you're taking half a class and half a class.
Right.
So what's the point of it then? Since classes are usually 15
The point is
weeks.
it's a checkpoint.
Right.
They did the same thing with the math classes.
Mm-hmm.
Madden explained this to us when
Yeah.
I was freaking out, and she said a lot of people had issues taking the math classes, and something similar is happening with accounting. So what they're doing is they're essentially going, okay, well, you do really well in this part, but you don't do well in the second half. So you fail the entire class because you failed the second class or the second part of the class.
Correct.
So in splitting it in half, what they're doing is saying, well, you did well in the first half. Good job. There's your 2 credits, but you failed the second part. You don't have to take the first part again.
Correct.
You only take the second part again. That's the point of this.
And I believe it's worked out well with math. They did that with the math classes, I think, a year ago. It might be a little bit longer. but it has actually, I think, worked out well. And that was exactly what it was. People would get halfway through, but then they didn't want to take the whole class over again and pay for the whole class over again. So it does make sense. What didn't make sense to me was you could take half of 101 and then take the first half of 200. That didn't jive, but I could have misunderstood that as well. And you'll get more information from your advisors about that. And oh, bloody hell. Sorry. It will, you'll get more about that. We're trying to keep up with everything. Sometimes we get so many emails and I just kind of go, yeah, I'll read it later, and then later doesn't happen. And I know you're probably the same way. Not with your emails. Yours I do read, but some of the stuff from the college is just so, if you're an adjunct, it doesn't always apply as well. And so it's like, I just read that and wasted 10 minutes of my day for nothing. But anyway, the first thing I want to do, because it's later than 12:30, and I guess some people are not going to show up. Oksana, you're here? Yes. Duran did not get here yet. Who else? Jamad? Madison? Okay, they're the people I don't have. Okay, if you were in Corey's group, please let me know the other day, because everybody else put all their names on except Corey, so I guess he wanted all the points. And I didn't know who was in his group, and I'm like, okay, I don't know for sure. So just shoot me an email later on and say that you were in Corey's group, and I'll make sure you get the points, because I graded your quizzes last night and put the points up. Some of you struggled with some of those things, so I would advise that you go and review that stuff again. The next 2 parts of the tutorial are up. It's actually 1 part. It's part 4. Or 5, I'm not sure which, but I did it in 2 videos because it was getting really long. It was like 30 minutes for the first one, and I wasn't finished, and I didn't realize that there wasn't that much left to do, but I thought I'm going to cut it now and do the second part. The second part has the mastery thing as well. I'm going to try to get the next part done this weekend. It's actually, it may not even be that long, because the next part is doing the financial statements. And some of it, I know when I'm going through it, you're probably laughing at me because I'm like, this is boring. This is just like shoving numbers, but it's kind of, okay. It's kind of, it's good practice for y'all, I think, to follow along and do that one if you want to. Let me write this down. It was Jacob, Dwayne, and Jamad. Okay. I'll get you their grades in later on today. Okay, your exam is going to be on 5 and 6. I'm probably going to open it on Wednesday of next week, because we should finish 6 today, and close it on Friday. And I'll post a review here when I get a chance for what's on it. It's going to be on D2L. You'll go into quizzes and it'll show up. It should show up as exam 3, and then it should grade it automatically, and your grade will show up. I will give you 2 chances to do it. It is going to be timed, because I don't want you to have time to look things up on Google. And even though I know you'll have your book in front of you, I expect that. I'm not going to tell you to do it. I'm not going to tell you not to. Okay. It is multiple choice and true false, just like the other ones you've had.
Okay, awesome. Thank you.
You're welcome. The true false are first, and then the multiple choice are next. Just like the other ones you had. It's 50 questions. That much I know. I'm not exactly sure what's on it. It's 5 and 6. So there is some definitions and some other stuff, just like the other ones you've had up till now.
What about the other stuff, like that other website? I forget what it's called right now.
Pearson?
Where the quizzes are? Yeah, Pearson.
No, it won't be on there. You do.
No, it's like, is the stuff on there? Like, didn't we have a quiz due or something over the weekend and it was down?
It shouldn't have been on yours.
So we don't have anything doing that?
You don't have quizzes on there. My online classes do, but you don't.
Oh.
You trust me, you don't want to do a test or a quiz on Pearson. They're a pain in the butt. But
I'd prefer not.
With my online classes, that's basically the choice I have. to do it there. They have quizzes like you do, but they do them on there. But their tests are just like yours. They're in the in D2L. It's much easier to do it in D2L. It's a little more work for me to get it in there, but actually it's not. It's just as easy to do it there. So that's where it will be. I don't usually time them, but I'm going to this time. I think I said that already. Okay. We're probably not going to get a chance, and I didn't pick a problem. So to do a chapter 6 quiz today, I will send you out something probably on Friday or Saturday to do together on Monday. And then we will get into chapter 7 on Monday, because we don't have to take the time to do the test in class. So we've got a little bit of extra time that we can spend doing this stuff. Okay. Also, I just want to throw this out. If anybody needs extra help, because we're not really doing office hours, if you need me, send me an email. I can set up a Zoom session anytime that I'm available. And it can be just a one-on-one kind of thing for an hour or two. That's fine. I just need to know, so we can get schedules together. There are some times when I'm not available, but not always. I wish you could see him. Maverick is standing on the sofa in the living room, staring out the window at something out there, and he's like, his feet are in the sofa, and his front paws are up on the back of the sofa, and he's staring out the window, and it's probably a squirrel. Anyhow,
that is a good watchdog right there.
Oh, he sees all the critters out there. And I live in the woods. I don't know how much you can see. You probably can't out my window, but I'm deep in the woods up here. So, alrighty. So that's the plan for today. Anybody got any questions? Issues? Otherwise? Nope. Okay. All right. So if I can remember how to do this, I will share my screen. And what do I want? This one. I think that's what I want. Yeah, okay. All righty. How do we count for inventory? This is what we were doing the last time. Slideshow. Thank you. From the current slide. It's being slow. Okay. I got all of that. I'm going to make sure I did everything I wrote down here. Okay, so the cost of inventory. We talked about the cost of inventory the last time. Inventory is the stuff that you're holding on to for sale. If you're a retailer, and I remember telling you, don't worry about if you're not making stuff to sell, because if you are, that's a whole different ballgame. That's part of Accounting 200, or it used to be. I should look through that book and see what actually it covers. I know it. I'm not even sure where it starts. I think it starts with the statement of cash flows, but I'll look on that if anybody's interested. Okay, so on the balance sheet, you have the asset, the cost of the inventory on hand, and it's recorded at the cost. It's recorded at what it cost the company. And then that becomes an expense on the income statement. That's what you record there, the cost of goods sold, what it actually cost the company to buy that stuff. The sale price is what you're selling it for. Revenue is based on the sale price. So you sell something, if I were to sell this scarf here that I'm not crazy about, I'm trying to think what I paid for that yarn. I think I paid like $6 a ball. So that would be, it's 2 balls, it would be $12 would be the cost of the goods sold. And I would sell it for, I'd sell it for say 25. That would be my sales revenue. So it's always the bigger number should be the sales revenue. If you're selling it for less than that, you got a problem. You're taking a loss. Cost of goods sold is based on the number that you sold times the cost per unit. So if you sold 15 different things, you'd have to look at the cost of each one. And then what's on the balance sheet is what you have left, what you still haven't sold, the number of units on hand times the cost per unit of inventory. Just basically common sense, I think. Right. Okay. They show you a bunch of things here that I'm kind of like, yeah, this is kind of like a waste of slides, but they're showing you Under Armour's balance sheet where they have inventories, and inventory is usually, it's a current asset, and it's usually either above or under accounts receivable, because inventory is not normally something that you're going to keep around. Think about toilet paper flying out the door. That's not something. My husband scored some today. We are good. And paper towels too. So that's it's something that, unless you're selling something really big, it's going to be a current asset. If you're selling houses, it's probably not. Probably going to be down in the long term. And then on your income statement, you've got sales, and then you're going to take out your cost of goods sold to get gross profit, which is also called gross margin. They like to give you two terms for things because, hey, we can't keep it easy. It's accounting, right? Okay. The number of units of inventory is determined from the accounting records. You know what you have. You should have an idea of how much you've bought throughout the year and how much you've sold throughout the year. And every company, no matter what method they use, we'll get into those in a few minutes, should take a physical count at the year end. Does anybody do inventory? Ashley has.
Where you have liquor at the bar.
Right. You probably do that more than once a year.
Yeah, we do that every 2 weeks.
Okay. And so you know how to deal for losses and stuff too? I was once told if you couldn't steal from a bar, if you were a bartender and you couldn't steal, there was something wrong with you. Actually, one of my accounting professors told us that it's kind of a built-in thing of the bartenders stealing. I don't know if that's still true. Anyway, but you want to know how much you have and how much you've sold, how much you have left. And you're also, like, think about grocery stores. You're going to have spoilage. You're going to have stuff get broken. And so we deal with that later on. But one of the things that you're doing to look at stop it. He's about to knock everything off the table. Look at what you had and what you've sold and what you have left and see if it matches. And one of the things, if you've read it in the end of the chapter, that talks about figuring out kind of, if you don't have all the records, how you can get an estimate of that. Consignments, we talk about a little bit shortly. Consigned goods are things that, like, we don't have a lot of consignment shops around here, but back when I lived up in New York, there was a place that my mother used to make quilts, and she would sell them. The first one she sold for $35. It was a full-size hand-quilted quilt, but she would take it to this store, and the lady would sell the stuff for her, and then my mother would get whatever price she put on it, and the lady that owned the place would get a certain percentage. She would add to it, like 10%, and that was hers. So those are consigned goods, and they don't belong to the company. The quilt belonged to my mother. So when that company took inventory, they wouldn't count those as belonging to them. They are things that are out on consignment. They're not anything that belongs to you. And in transit goods, we talked about back in chapter 5, depends on the shipping terms. Remember, I told you that I get confused with those. The shipping terms, I think I've got it figured out. It depends on what the shipping terms are, whether it belongs to the company or not. And if you're dealing with a lot of stuff.
Hi. Do you mind going back to the other slide?
I will. This one?
Yes. The under consigned goods, the second one, it says include those out on consignment. What does that mean?
It means that if you are the person who has the stuff out, so like my mother's quilt, she would count it. Maverick, please. He's at me. She would count that as belonging to her. So it wasn't in her possession. It was out at the store. Hang on. Come on. Go. Sorry about that. Okay. Things that are out on consignment are things that you own, but you don't have them in your possession. You have them out at the store to be sold. Somebody else is selling them for you. Does that make sense?
Yeah. Okay. But why do we include those out on consignment? That's what I don't get.
Okay, if you own it and you were saying, what do I have in my inventory? What should I put on my inventory, on my balance sheet? You want to include those things because you still own them, even though they're not right there. There's a one little problem. I don't know if it was in the other book, where they would say somebody has this many things, and some of them are damaged, and some of them are out on consignment, and which ones do they actually include in their inventory? And it's, even though they're out on consignment, which means they're out at another store being sold, that's they still belong to you. Okay. Does it?
Yeah.
Okay. Alrighty. The two shipping terms are shipping point and destination. FOB stands for free on board. I always thought it meant freight on board, which makes more sense to me. So whoever owns them, the company with the legal title, is the one that pays the transportation costs and also is the one that owns those things and counts them in their inventory. So if it's FOB shipping point, they belong to the person that's getting them. So when you buy stuff on Amazon, just my best friend, that's FOB. If you're at Prime and you don't pay shipping, that's shipping point. It belongs to me when it leaves the shipping dock. So Amazon no longer owns that. It's mine now. FOB destination means I own it when it gets to me, when the goods are delivered to the customer. And usually I think that's the one where you have to pay shipping, is FOB destination. It matters who owns it, because if you've got stuff that's destination and it's sitting in a truck somewhere in the middle of a snowstorm and you decide to take an inventory, it belongs to the shipper. It doesn't belong to the customer yet because it's still sitting on that truck. But if it's shipping point, then it would belong to the customer at that point. Okay? Those are just terms that you have to pay attention to when you're figuring out the costs. Cost per unit, if nothing changed throughout the year, if everything always stayed the same, it would be easy. But, prices go up and down. One of my friends told me she paid $8 for 6 rolls of teepee today, and I'm like, what? I think that's price gouging. And whoever thought we'd talk this much about teepee? Okay. Because of differing prices. And think about, these are not different things. These are like something that's all the same. So you've got a jug of milk, milk's milk, or a loaf of bread. Bread is bread. It's all the same stuff, but the price goes up and down. So you're not paying attention always. You're not going to keep track of exactly which one is sold. You're not going to look at a ball of yarn and say that's a red ball of yarn that I paid $5 for, but that same red ball of yarn I got on sale at Hobby Lobby and I paid $3 for. I don't know which one's which. There's just 2 balls of yarn. I got the unstable. Are we back?
Yeah, you're still garbled.
Okay. Now?
Say again?
Am I still?
Yeah, there's still lag.
Okay. Oh, wait a second. It'll give you a chance to catch up.
Right.
Okay.
You might be okay now.
Okay. Are we okay? All right.
Better.
So,
I wouldn't say it's 100%, but it's better.
okay. We're talking about the costs that we're going to, what are we going to put into ending inventory and what are we going to put into cost of goods sold? And so you have to think about, how am I going to calculate this? And nobody's going to go in and count all of the jugs of milk or all of the balls of yarn. So you're kind of going to you're going to use one of the methods that is acceptable under GAAP. There's 2 different types of inventory systems, the perpetual system and the periodic. You don't have to know how to do the periodic, you just have to know the differences, basically. With the perpetual system, you keep a running record of everything that's bought, sold, and on hand. And you can use it for anything. So when you go to the bookstore and they scan your book, it tells them that's a perpetual inventory system. It tells them that that book is no longer on the shelf, that it's been sold. With that kind of system, there's usually an automatic reorder point. So if it gets down to 2 copies, we order again automatically. you know what has been bought, what's been sold, and what you still have. But you still should count at least once a year because you're going to have things like people stealing stuff, things getting broken, that kind of thing. With the periodic system, and some companies still do this for inexpensive stuff, you don't keep a running record of everything that's constantly going on. You just have sales. And inventory is counted at least once a year, because that's really the only way you know what you had and what you've sold and what you still have on hand. That was the way the bookstore did it that my sister ended up owning. We did the inventory once a year. It was always fun. It would take a couple days to do, and there was usually drinking involved toward the end. But anyway, that's the two different systems. Most companies use perpetual, so that's the one that we pretty much focus on. But the periodic system, some companies do still use. And for some of your businesses, that's probably the easiest way to go, is to use the periodic depending on what you're selling. With a perpetual system, and we did this back in chapter 5, when the store makes a sale, you do the 2 entries. You debit cash or accounts receivable, credit sales, and then debit cost of goods sold and credit inventory. Remember that from last chapter, I hope. Everyone?
Yes, we are alive.
Okay. I'm like, crickets. Okay. And this just is an example of those journal entries that we did. We did that last chapter. I remember doing it. You would debit inventory and credit accounts payable when you bought the stuff for the $560, and that's what you paid for it. And then when you sell it, and again, this is always going to be the higher number for now, debit accounts receivable, credit sales revenue, and debit cost of goods sold and credit inventory. This is what you sold it for. This is what it cost. And you're always going to have those two. With the periodic system, you don't have this one. You only have this one. So people like it better, but it's not actually acceptable. They show you here the T accounts for inventory and cost of goods sold. So the beginning balance, they just tell you, was 100,000. This is the purchases from the last one. And then your cost of goods sold reduces that inventory. So you would have had 660 here, minus the 540 would give you an ending balance in your inventory of 120,000. Now, it tells you in your book, I believe, don't think of this as units, think of it as dollars, and that's actually what it is. But I sometimes think it's easier if you think of it as units, that for you guys to think of it that way, it just kind of helps it to make a little bit more sense. Excuse me, cost of goods sold was then the 540. It gets credited to your inventory and debited to the expense. This is an expense. It's a selling expense on your income statement. On the income statement, you're going to see your sales revenue, which is what you just saw, minus your cost of goods sold to give you your gross profit. And then on the balance sheet, this is your ending inventory, the 120. And again, it's in current assets, usually higher. Okay. Cost of inventory. How do we decide what to record for the cost of inventory? You're going to take your purchase price, in this case, the 600,000. Freight in is an expense, which they never mention up until now. It's an expense. It's the cost of transport. It's a shipping expense if you have to pay it. If you have to pay shipping. In this case, they have to pay $4,000. Purchases returns we talked about the last time, did we not? Or did we just do sales returns? I'm as bad as you guys. Purchases returns are the other side of sales returns. So they returned unsuitable goods of $25,000, got an allowance because they paid early. And they got, no, that's just because they liked them, the $5,000. The discount was for paying early. And then this is the final cost, the $560. So they basically got $40,000 off for all of these things. This is the cost that they want to record. All of these things would be recorded as well, but this is the cost of the inventory. And that's what goes on your balance sheet. And here they're showing you what they just went through, kind of the same. Did we talk about purchases returns before? Apparently not. It's the other side of sales returns, which I know we talked about the last time. So if you return merchandise that costs $500, I bought some stuff, it's not stuff I want, I'm going to send it back. I'm going to debit my accounts payable and credit inventory. The discount here was, this is the original purchase they're showing you, and this is still, we did the 2%, remember 210 net 30 from the last one. Debited inventory for 1,000, credited accounts payable, and then paid within the discount period, they're going to get 2% because it tells you 2% discount here. Debit accounts payable for the whole amount, credit inventory for 20, and credit cash for 980. You want to do this because A, to make it balanced, and B, you want the inventory recorded at what you actually paid for it. So you've already debited inventory for 1,000 here. You want to get rid of that $20 that you're not paying. You're only actually paying $980. Does that make sense?
Wait, so you record the inventory at what you bought it for?
Yes. Now, there's two ways to do this. There's the gross method and the net method. We only actually talk about the gross method. So in your business, you may use a different one, the net. But in the gross method, you record the inventory here, the $1,000. They're saying 1,000 units times $1. So you debited inventory for the $1,000 and credit accounts payable for the $1,000. Then when you go pay it, the 10 days later, that's when you're allowed to get the discount. They're giving you the 2% for paying early. And this is the opposite side of what we did the last time with the sales discounts. Now you're on the other side of it. You're the person paying. You get to keep $20. So you're going to debit the entire accounts payable because you want to make that T account go away. And credit your cash for the $980. That's what you're actually paying. And the other $20, you're going to credit your inventory. So if I can, let me stop sharing this one and I'll pull up the whiteboard. And I'll see if I can, I'll do a T account, if I can do one. I'm not real good at lines. Oops. Oh man, that's awful. Okay, let's do I have a straight line here? What's that? I haven't played with this very much. Okay, there. And will it let me go down? I don't want to move it down. I want to draw a line. No, why won't it let me draw a line? There we go. Okay. Now I want text. This is real annoying. Okay, so over here, if this is your accounts payable, on the credit side, I want this. I had $1,000, right? So if I don't get rid of that when I pay this company, it's going to look like I still owe. If I only put the 9, this is really annoying. Probably more so for you. The 980 over here, it'll look like I have a balance. I'm getting better with the line though. I don't want that. I want to draw a, never mind. We'll just put it over here. I'd have $20, right, as the balance. And I actually don't. I don't owe them the $20. So I want to get rid of the whole $1,000 over here and make that be a 0. Then that would be, oh, that's like really bad. Yeah, I'll stop sharing that. Let's go back to my slides. I think that's where we were. Okay. That's not where we were. Why didn't it go back to the same slide? This is where we were. Okay, does that make more sense? Sorry for the technical glitches.
Yep.
I should play with that a little more. Okay. So what do we add in for inventory? All the costs that are incurred to bring it to its intended use. So if you have to pay insurance while it's in transit, if you have to pay fees or taxes to get it ready to sell, basically anything you have to do to get it ready to sell is going to be part of the cost that you're going to include, including the purchase price. And, ooh, what happened? I think hates me. Did that. Am I going backwards?
Yes. Yes, you are.
Now I am. What in the? There. I'm not touching the mouse. Okay. So anything that you had to do, if you had to do some testing to make sure it's running correctly, you would add that in as part of the cost. If you have to pay fees or taxes, you have to pay that. That's part of the cost. If you are going down a street and your truck is too heavy and you get a fine, that's not part of the cost. That's stupidity. Or a speeding ticket, that's not part of the cost. That's your fault. Okay? There's a couple of different accounting methods for various inventory cost methods, and you've probably heard of some
Can
of
you
them.
go back to that slide, please?
Yes. I'm using the arrows instead of the mouse.
Thank you.
Sure. So I know you've heard of some of these LIFO, FIFO. A company can choose an accounting method for accounting for inventory. And the method that they choose, and we're going to get into all four of them, will affect the profits reported, the income tax paid, and these two ratios that we're going to talk about as well. Pretty much all four are acceptable. Some of them the government prefers that you use, the IRS prefers. If you use LIFO I think it's LIFO for your taxes, you also have to use it for your business records. It's one of those, this is one of the things that you can have two sets of books, and it's perfectly legal. You can have one for your internal and one for the IRS, and it's okay. But what your business is really will tell you what method you should use. The four of them are listed here. You have specific identification, average cost, first in, first out, and last in, first out. Each one has its own way of calculating things, and we go through everything. We'll go through all four of them as we get there. The specific identification one is actually the easiest one, and it's the one that causes students the most fits. And I think because it's the easiest one that it does that. So be prepared. It's not that hard. It's really not. Okay. Specific ID is used for businesses with unique inventory items. So think about like cars, the things they show you here, antique furniture, real estate. You know exactly what those particular things cost. So you can say, okay, I know that this Ferrari cost me, I don't know what Ferraris cost, $40,000, and I'm selling it for $100,000, and I know that that one over there cost $50,000, and I'm selling it for another price. So those are the things that you know exactly what you paid for them. A house, that kind of thing you would know. So those are, this is definitely what I paid for it. This is what I'm going to sell it for, and I know what my costs are that are going to go on my balance sheet. But if it's something that, I'm not going to do that with every ball of yarn. Okay, if I own a yarn store or even a bookstore, anything like that, I'm not going to do that. I'm not going to look at every individual item and say, I paid 50 cents for this ball of yarn and I paid a quarter more for that one. I don't know. Okay. This they go through, they use the same data for all 4 of them. And what they're showing you here, and one of the things that they love to ask you in questions is, what's your ending inventory? What's the cost of ending inventory? They're showing you here that they bought 10 units and they paid $100. They paid $10 for each one. So that's $100. Then they bought 25 units and they paid $14 for each one. Bought another 25 and they paid $18. So if you add up the total of this, the total cost comes to $900. Yes. They sold 40, but they're not sure which cost to assign to them. And they know they have 20 left, but they're not sure which of these costs to assign to those. So that's the thing that you're looking at. That's what you're trying to figure out. What do I assign to what I sold? What do I assign to what I have left? And this information, I believe they use for all 4 of them. They don't go through specific ID in detail because it's something that's not actually used all that often. But I'll see if there's a problem. I'll put up some, let me make a note to put up some practice problems for this chapter as well. Do the practice problems help?
Yes.
Okay.
Yes.
Okay, good. Do the videos, the tutorial, does that help?
Yeah.
I didn't.
Yes.
Okay, I didn't realize. I thought you had all the parts, and I didn't realize that I had started with like part 3 for y'all. So last night I did put all of the parts in there, and I made it its own module, I believe. So you should be able to find them in there. So it's the first one says video 6 or something. I'm not sure why, because it names things weird when I use Screencast-O-Matic. Okay. All right, so we're going to go through average cost. Average cost is what a lot of companies use. If you've got things that are all the same, like my balls of yarn and stuff, I could walk in the craft room and go, okay, I've got this brand of yarn, and on average, I pay this price for each ball. With this brand of yarn, on average, you pay this price for it. With, like, think of grocery stores or J. Antonio's bar, you're going to pay so much per bottle of Jack Daniels. Okay, maybe you get a sale, and so you get it cheaper one time. Maybe you get paid more for it at one time, but you're going to get an average. You're not going to look at each individual bottle. So they show you here this kind of little, I guess it's like a pool, where the purchases go in on the top and the cost of goods sold kind of comes out the side. It's like, this is an average. And how do you calculate this? This is the one that takes the most from your calculator. Your average cost per unit you have to figure out. So you're going to take the cost of the goods available, which is the total of the inventory. So we know that was $900. The 100 plus the 350 plus the 450 was $900. So that's your total cost. You know that you had 60 units, 10 plus 25 plus 25. So it's the total cost divided by total number of units available. Gives you $15. So even though you paid 10 here, 14 here, and 18, on average, you paid 15. Now with a perpetual system, you normally calculate it each time there's a purchase. And then you have to get a new average. But in this case, they're only showing you 2 purchases, and I know on your test I didn't get any fancier than that, but you might see it in a problem that it has more than one with the perpetual system. So just be aware of that. So then when you figure out your cost of goods sold, you know you sold 40 of whatever this is at an average cost of $15. So your cost of goods sold becomes $600. You know your ending inventory, you have 20 left, times 15 is $300. So that equals your $900. Does that make sense? That's the formula. You have to figure out the total cost of goods available, the $900, and then the number of units available. Not the ending balance, that's the 20. You have 60 that you bought throughout the period, and then divide to get the $15. Then you look at how many you sold, times that $15, and then what's left is that number of units times that same average cost. Make sense, everybody? That one can make your calculator really smoke if you have a lot of different times that you're buying and selling, because then you have to calculate each time. With the perpetual system. With the periodic, you only do it once. But with perpetual, you would be constantly calculating. And a lot of this stuff, yeah, I know is done on computer, but we have to do it the hard way. Okay, any questions about average cost? Okay. And this is just showing you the T account for the cost of goods sold. You can't see it, it's the 600, but the ending balance is the 300. I feel like I'm pointing at the screen like you can see me pointing at the screen. You can see me pointing, but okay. With first in, first out, okay, they show you the purchases going in the top and the cost of goods sold going out the bottom. First costs are the first into inventory are first costs assigned to cost of goods sold. So you're thinking about, okay, I bought this stuff. The first stuff I bought, I got yarn upstairs that's older than y'all. My mother bought it, okay? That, whatever I paid for that would be the cost that I assigned to what I'm selling today. So the first cost is the first out the door. It's not actually the items, but you can think of it that way if it makes it easier. The first things you bought are the first things you sell. So I'm going to go all the way to the back of the store. Well, actually, I call this the lazy clerk method because the first stuff you bought is going to be up at the front. If you brought it in the back of the warehouse, it's going to be up at the front because you're going to keep bringing stuff in and putting it back, right? So you walk from the front door back to there and pull the first stuff, and that's the stuff I'm selling. Does that make sense? This is one of those where they say don't think of it as items, but it kind of makes more sense if you do. Okay, so in this case, you're going to say, okay, I had 10 units. Again, you have 50 units or 60 units, and you're selling 40. All right, so over here, this comes to 540. When you sell 40 units, you start at the top. You say, I sold 10, that cost me $10. That's my first level. That's got to go first. They're the first ones I bought. Shoot them out the door. I'm selling 25 more. That's Maverick. At 14, he's outside. So 25 times 14 here is 350. Now that only gives me 35. I sold 40. So I'm going to take 5 out of this pile that cost 18. So what I have left over here, because I got rid of these, I got 20 left here. It's still the same 40 and 20. It's still 60 units, but you're separating the cost differently. So over here, if I add these up, my cost of goods sold is 540. With the last one, remember, it was 600. And what I have left is 20 units that I paid 18 for. That's 360. So you're looking at the same items, you're just looking at a different way of assigning costs. Does that make sense? First in, first out the door. FIFO.
Why would someone, like what example of a business would record like that?
Most actually do use FIFO. No, they don't. They use LIFO. It has to do with taxes. It has to do with how much you want your ending inventory to be and to be priced at, and what you want your cost of goods sold to be. Because the higher your cost of goods sold, the lower your net income. The lower your net income, the lower your taxes. So you kind of look at what's my business and which one's going to work out best for me. So with something that you have to think too about replacement cost. You have to think about like what happens if, in this case, the highest costs here, the $18, that's what I'm assigning to my ending inventory. I'm saying that what I've got sitting in my store is worth it. I paid $18 for each one. So if something should happen and I have to replace those, I have a higher cost of my ending inventory to tell the insurance company to say, this is what it's going to cost me to replace them. So that's something else that you have to think about with this. I kind of didn't answer your question, but kind of did.
Okay.
No, I understand.
Okay.
Well, for instance, right, if I have let's say something like groceries
Mm-hmm.
and the like expiring date on it,
Right.
and my inventory came in the store, is it something like the first ones that came with the earliest expiring date, are those the ones I'm going to push out first? Is that
Yes.
what this means?
Yeah. So think about when you go to buy milk. Okay. If you buy milk, well, these days you get what you can, but normally you would always reach to the back. Don't take the first
Yeah,
one. You
I
reach to
do
the
that.
right. You reach to the back because that's going to have the furthest expiration date. That's
Yeah.
what they're doing. They're pushing the first ones to the front. I always say when you put your groceries away, what you should do is exactly that. You should put the new stuff in the back, so you're always using the older stuff. It doesn't happen in my house. I just kind of put it on the shelf. And my story is my sister, after her husband died, she went on a cleaning binge, and it was he died very suddenly. So it was one of those things that kind of helped her get through things. And she called me one day and she goes, I found Bisquick in my closet. And I said, and she goes, guess what the expiration date was? I can't imagine. It was like 20 years. It had expired 20 years ago. I said, did you make anything? She was like, no, didn't want to do that. I had some that the expiration date was like 12 years, but because, things just get pushed back. That's the next method. That's LIFO, is what you're doing. With this one, it should be, and grocery store is a perfect example. You should be using the first stuff that came in. That's what they want to get rid of. The grocery stores have a whole different set of issues, but that's a really good example. That I
And
want
you also said something about cost of replacing.
Yeah.
Is that what you said?
Yeah.
What is that about? Like, what do you mean by that?
If, say, there was a fire at your store and everything was destroyed, and you have to say to the insurance company, this is what my ending inventory was worth. So they're going to give you an amount. With this one, you're going to have a higher amount than with the next one that we're going to look at, because what you're looking at here are the last costs, the $18. That's what I'm saying my ending inventory is, what I still had in the store was worth. I paid $18 for each of them. So I'm going to have a higher amount there. And a lower amount for cost of goods sold because I'm using the oldest costs over there. Okay.
Thank you.
Now, this stuff, it can be confusing, so it's better to take some time. If we don't get through the whole thing today, we will. Okay. Last in, first out is the opposite of FIFO. And so they're showing you here the purchases go in the top and the cost of goods sold comes out of the top. So this is the case of putting the new milk in the front and leaving the old milk in the back. And the way I put groceries away, I put the new stuff on the shelf and then find things that we moved here 15 years ago and stuff that needs to be thrown out. So your last costs go into inventory, go immediately to cost of goods sold. And the oldest costs then are going to stay in your ending inventory. So your ending inventory is always going to be, if prices are going up, which they normally are, and there's a way to account for it if they're not, and that comes next, if prices are going down. But if prices are going up, then LIFO is going to show the highest costs going out to cost of goods sold and the lowest cost staying in your ending inventory. So here's the same example where you still have, the, 60 units. And these were the costs, and it came to, $900. When you sell 40 units, in this case, and I'll use a bar example for y'all, you've heard of top shelf liquor. With FIFO, you take the top shelf off first. With LIFO, you go from the bottom shelf You sell the cheap stuff first. Only it's not, it's usually more expensive. Okay, so in this case, the cost of goods sold for 40 units. They're selling the same 40 units. You're going to start at the bottom and you're going to say, I sold those 25. They're all gone. And I need 15 more, so I'm going to go into this pile and take my 15 there. So I can't see what this comes to, but I think it's 640, 660. Yeah, it should be 660. Over here, then what I have left, these are still sitting there. And I got 10 sitting out of this pile. So I got 10 that I paid $10 for, 10 that I paid $14 for a total of $240. So it's going to show you in a minute the difference between all of these, the four methods. You're going to get a different cost of goods sold. You're going to get a different ending balance in inventory for each one. The calculations, there's a chart in, I think it's in your working papers. There are charts that you can use to calculate these things. I don't care how you do it. I don't care what method how you get your numbers. I just care that you get them. Not a math class. Now he's pouting. Okay, any questions? And this shows the differences. The sales revenue is going to be the same across the board. Doesn't matter. Cost of goods sold with FIFO, first in, first out, your cost of goods sold is the lowest because you're assigning the lowest cost to what you sold. And so your gross profit is the highest because gross profit's the difference between the revenue and the cost of goods sold. With LIFO, because you're assigning the highest costs to the stuff you sold, you're going to have the highest cost of goods sold and the lowest gross profit. So you're paying less taxes. I just got the unstable message. I know I'm unstable. Are we back?
Yeah. We're good.
An average cost kind of smooths out the differences. So think like with average cost, I usually use gas prices because, they're always going up, down, and this kind of smooths it out. It's like, this is the average, okay? So a company will choose based on pretty much the tax effects of these. This chapter in your book gets into a lot more detail than what you guys really need to know. Some of the stuff as I'm reading, I'm going, I did this in grad school. So some of it I'm just going to skip over. But when inventory costs are increasing, and this is what companies are looking at, FIFO cost of goods sold is lowest, and this is what I've been telling you because it's based on the oldest costs. Therefore, gross profit is the highest. Ending inventory is the highest because it's based on the recent costs, which are the highest when prices are increasing. With LIFO, cost of goods sold is highest because it's based on recent costs and gross profit is the lowest. And then ending inventory is lowest because it's based on the oldest costs. So they're just basically the opposite of each other. They don't talk about specific identification because that's really, exactly with that, what's going on. And with the other one, with average cost, which you'll also see called weighted average, that smooths out the differences. Weighted average is a little bit more complicated than just average cost, but again, that's grad school stuff that we did. Excuse me. And I'm serious about that. I looked at this number, not this. Okay. When inventory costs are decreasing, then it's going to be the opposite. FIFO COGS is highest because it's based on oldest costs, but it's actually the same. It should be the same. No, it's lowest. Okay. If they're decreasing, yeah, it's the opposite. And ending inventory would be lowest because it's based on recent costs. If they're increasing, it's going to be the opposite of this. And if they're decreasing, then LIFO is going to be the lowest for cost of goods sold and ending inventory the highest. So companies are going to look at that and decide which one do I want to use. Once you pick one, you have to stay with it. I went the other way. When costs are rising, one of my friends used to say, life rises. LIFO results in the lowest taxable income, which results in the lowest income taxes, increasing your cash that's available. And that's why most companies use LIFO. You see the difference here. Your gross profit was $460 as opposed to $340. Operating expenses are going to be the same. You're just assuming your income before income tax under FIFO is $200. Over here it's $80. So your income tax expense is $80 as opposed to $32. Nobody wants to pay taxes. And that's why they use LIFO a lot. Make sense? I don't want to whip too fast through them. I want you to catch up. Are we ready? I can't see Oksana writing anymore. The tax advantages of LIFO gives you a more realistic net income, and more recent costs are assigned to cost of goods sold. FIFO gives you a more up-to-date inventory cost, because with LIFO you're using the most recent cost to go out to cost of goods sold, where with FIFO you've got the more up-to-date inventory costs in your on your balance sheet. So you pick which one you want. Okay. And this is a little bit, this is the stuff that I was saying is a little bit beyond all of y'all, but a company will choose LIFO normally because you can time your purchases, and if inventory purchases are rising, you're going to buy a lot of stuff so you can pay lower taxes. You're going to have greater cost of goods sold. That's assuming that you're going to sell it all. Okay. LIFO liquidation is something that is actually beyond you guys. It's there's something called LIFO layers, and that, I'll tell you the truth, made my head spin in grad school. You have layers of the costs, and with a liquidation it means your quantities fall below this level, and so then you've got to dip into older levels, and that will shift the costs into cost of goods sold. But that's way up there. So just be aware that there's something called LIFO liquidation. Don't worry about how it actually works. Financial statements have to report enough information for outsiders to make informed decision. We talked about disclosure, full disclosure back in chapter 1. So they have to put in their notes which method they're using, and you will see that in a company's notes that we use LIFO. And sometimes they'll use LIFO for one thing and FIFO for another, and weighted average for something else, depending on what they're selling. They may have a bunch of different things that they're selling. Representational faithfulness means that they disclose the inventory methods and the substance of all material transactions. And then consistency. Okay, consistency means you use the same method from period to period. You can change, but they don't like it. IRS doesn't like it. So it's basically you better have a good reason, and you can change once. Once you've changed, you're stuck with it. So make sure you want to do it. And if you use, I think LIFO for taxes, you have to use it for, or no, FIFO, you have to use it for your books as well. Okay. Any questions about those? I'll get into that part of the problem, the tutorial, hopefully this weekend, and then that will probably help you go through it, help you to make a little more sense of it as well. Some of this stuff you have to do to make it make sense. Okay? Ever notice how much you touch your face? And I'm like, it's my face. I'm touching it if I want to. You can't tell me I can't. I did not pick my nose just then. I rubbed it. Okay. Lower of cost or market is something that you apply if inventory is constantly going down. If the prices of what you're buying is decreasing. based on relevance and representational faithfulness. You want to make sure that things are recorded at the actual price. So it requires inventory be reported at either historic cost or market value, which usually means net realizable value. This is only used really for things that are constantly decreasing. So think about like computers. The first computer my husband bought me when I moved down here, I was actually still in grad school. I was going back and forth between here and New York. And I needed a laptop because I needed a computer here because his didn't have, back in the old days, didn't have Microsoft Office on them. They had something called Word, and not Word, Works. And I had to do this huge project, and I had to have graphs and stuff, and they didn't save on his computer. They didn't translate into Excel. So he bought me a laptop, and we paid $2,500 for that laptop. And I know that sounds insane. That's the one that I still have it upstairs, and the screen broke. And if I could replace the screen on that, I'd be a happy camper because I could play games on that one. Anyway, but you can't because now it costs more for the screen than it would be worth. That's the kind of thing that we're talking about. It's to replace it. It's more than it's worth. They're just constantly decreasing in value. So you want to show it on your balance sheet as what it's actually worth. You can't have something sitting on your balance sheet that's, you paid $100,000 for it, but today it's worth 40. There was an episode of, I used to watch Hoarders every now and again. It would make me want to go clean. And there was a gentleman who had, it actually makes me sad, but it was a gentleman who had like garages full of batteries, car batteries and stuff, and they were brand new in the box. And he was like, no, they're brand new in the box. They've never been taken out of the box. And they're saying to him, they're not worth anything, but they're brand new, but they're 50 years old. So, you couldn't put those on your balance sheet at what you paid for them because they're not worth anything now. So how do we figure this out? Under Armour paid $3 million for inventory. By its year end, it can be replaced for $2 million. So you have to report that inventory at LCM, stands for lower of cost or market. So cost in this case is less than market. Cost of goods sold, you're going to debit for the $1 million even though it wasn't sold, and inventory you're going to credit for the $1 million, and the explanation is wrote inventory down to market value. How do you figure out which one you should use? Usually you'll see a chart that will have, and they don't show it to you, but they'll have a chart that'll say, okay, this is cost, this is market, which one do we pick? And you're always going to pick the lowest. And it's just a matter of multiplication to figure out which one it is. But the journal entry is what's important because you're showing then that we wrote it down to market value. And then our inventory on our balance sheet looks, you can see that inventory at market, which is lower than the cost of $2 million. And then the cost of goods sold is the $9 million that they sold plus the $1 million write-off of that inventory, because you want those things to be as accurate as possible. So somebody looking at your inventory isn't going, whoa, they got inventory worth that much. No, they don't. Not worth that. Make sense? Anybody?
Sure.
Okay. Couple of different ratios that we have to do now. Gross profit percentage, inventory turnover, and days inventory outstanding. And again, you get a lot of these in Accounting 200, or yeah, I think you still do. There's like a whole chapter. That's because of the internet connection. Okay, gross profit percentage is an indicator of the company's ability to sell inventory at a profit, and of course you want it to be as high as possible. It's stated as a percentage of sales, and it's something that is carefully watched because you don't want it to go down, you want it to constantly increase. You take your gross profit divided by your net sales revenue to get a number. Under Armour's gross profit percentage is 46.4. So what does that mean? 46 cents of every dollar generated by sales is gross profit. So out of that 46 cents, they got to pay the bills. which is why you want it to be as high as possible. You want to have enough money to pay everything and still have some left over to play with on Amazon. Okay, gross profit divided by net sales revenue gives you that percentage. And to me, the 0.464 makes more sense than the 46% because that says 46 cents of every dollar generated is gross profit. These two are basically the same. They show you Under Armour and Nike. Nike is 0.462, Under Armour is 0.464. So they're doing pretty well, pretty much equivalent to each other. That was in 2016. I don't know about now. Anybody paying a couple $100 for sneakers? Okay. Inventory turnover tells you how fast the inventory is sold. It's the cost ratio of the cost of goods sold to your average inventory, and obviously varies from industry to industry. It's going to be a lot lower for Mercedes than it is going to be for a grocery store. You're going to want to move that milk where the Mercedes can sit there for a while. Probably, I wonder what their inventory turnover actually is. It'd be interesting to figure out. Anyway, take your cost of goods sold divided by average inventory. Average inventory is beginning plus ending divided by 2. That will give you, excuse me, average inventory. And that tells you how rapidly it's sold. The next one, you have to do that one to figure out. This one is the average amount of time inventory was on the shelf. So it's your inventory turnover divided by 365. That was inventory turnover. Divide that by 365, and then you'll get a number in days. How many days was it sitting on the shelf? So again, it's going to be different depending on the business. Some things will sit for longer. Yarn can sit on the shelf for weeks. Groceries, nope. I bet for TP right now it's about 15 minutes. Who'd have thunk it? And here it shows you some numbers for Under Armour and it's both for Under Armour. And they took the numbers from their balance sheet and income statement for 2016 and 2015. And for a lot of these things, again, you have to compare from year to year and you have to compare to industry average. It doesn't make sense just on its own. You're like, okay, days inventory outstanding for 2016 was 120 days. For 2015 was 117 days. So yeah, if you look at the two, it's 3 times a year or 3.12 times a year. They're turning it over faster in 2015 than they were in 2016. Why? I don't know. It's something, these numbers don't really mean anything in a vacuum. You kind of have to look at why. And you're going to have to do some investigating. And that's part of Accounting 200 is management stuff, looking at why did these things change? Why does it take 3 days longer than it did the year before? Is it our fault or is it market or what's going on? Nike turns theirs over faster than Under Armour, which kind of makes sense because Nike is a bigger company. I hate Nike. Y'all know that I hate Nike, right? I didn't tell you I hate Nike. I hate Nike. In grad school, we had to do a project, and my group chose Nike as our company. Nasty people. Okay, so that makes sense. And again, you'd also have to look at the industry average for those to decide if it's really good or really bad. The cost of goods sold model is something that I looked at this and I went, yeah, that just makes sense. Okay, it's just common sense. Okay, and this is something that I asked you to do for your project. It's just kind of telling you how you're doing. You start with your beginning inventory, add your purchases, subtract what you have available, subtract your ending inventory, and subtract your cost of goods sold. And that's going to give you what you have left I believe. And then really that just shows you paid $6,000 was your cost of goods sold. You can plan on how much inventory to buy, and that's also part of 200 budgeting. You want to know, what do I expect to need for the next period? So if I have $6,000 was my cost of goods sold this time, and I want $1,500 left in my ending inventory, or think of it as units. If I sold 6,000 units and I know that I want 1,500 left, I need to have 7,500, right? If I have 1,200 already left over, then I only need to buy 6,300 units. Make sense? If I want to, what am I going to make this week? I'm thinking, if I wanted to make spaghetti sauce, I know I use 3 big cans of sauce of the pureed tomatoes to make it, that I have 2 out there, but I don't want to use both of them. I want to still have 1 in the closet for something. So I better go buy, I have 2, I need 3. That would be 1 more, but I want 1 left. So I better go buy 2, I think. It tells you how much you need. If I want this much left, this is what I need. Okay? And that's really the cost of goods sold model. And that, again, is something that you will do in 200 budgeting. It's fun. It really is. Estimating inventory. And I think this is the last part of the chapter. Do I need to go back? I thought I heard something.
Yes, I can see you.
Okay. What it's saying is, if you're looking at selling $6,000 worth of stuff next period, and I want to end up with $1,500 worth of stuff next period, I need to have $7,500 during that period. If I've got $1,200 left over, then I don't have to buy $7,500. I have to buy $6,300. I've already got the $1,200. So in order to come up with this $6,015, I only need to add 63 to it. And it will go from period to period to period. You'll see in a budget that this is how much I want left over. This is how much I expect to sell. This is how much I need to buy. And you'll do it not just with inventory, but with with other things as well. Budgets, trust me, budgets are fun. Okay? Can I go ahead? I see.
Yes,
Yes.
please.
Okay. All righty. Estimating inventory by the gross profit method. This is something that I'm going to tell you, plug and chug. You're just going to plug numbers in. Known as the gross margin method. If I just want an estimate of the value of my ending inventory, I'm going to use this method. You're rearranging the cost of goods sold model to, why is it doing that? To figure out, give me an estimate of what I have. Again, they're showing you beginning inventory of 4,000, bought 16,000, so I have 20,000. My cost of goods sold was 15, would tell me my ending inventory was 5. If something was destroyed, you okay? A fire destroys some of Under Armour's inventory. Gross profit percentage of 35%. You can estimate the ending inventory. So the insurance company is going to want to know, and they're going to want some kind of, you can't just say I got $1 million worth of stuff. Okay. You gotta give them some kind of numbers. So here they show you beginning inventory, show you purchases, cost of goods available was 110. Now you should have those numbers. Estimated cost of goods sold. Net revenue of 100,000 less the estimated gross profit of 35%. Estimated cost of goods sold would be 65,000. So the estimated cost of the inventory lost is 45. That's what you would be telling the insurance company. This is our best estimate of what our ending inventory should have been and what was destroyed. It's also something you can kind of use, midterm, like I just want a guesstimate kind of thing for what have I got left. There's another way to do it that's a lot more complicated. We ready? The only one only one I can see is Ashley Kears, so I'm gauging it on her. Okay, inventory errors. Sometimes you make a mistake. An error in the ending inventory creates errors for 2 accounting periods. It'll be the next period, and then it will reverse itself in 2 consecutive periods. So if you have a mistake this period, it will reverse itself eventually. Beginning and ending inventory have opposite effects on cost of goods sold. Beginning inventory is added, ending inventory is subtracted from your cost of goods sold. So eventually it evens out. And it does happen. And you have to go back usually and say, oops, I made a mistake. So this is showing you your sales revenue doesn't change. Someday we're going to get through a whole class without Maverick interrupting. Beginning inventory for the first period. They've got 10,000, purchases of 50, cost of goods available 60, ending inventory of 20. I think the blue numbers is that. So cost of goods sold is 40 and gross profit is 60. If it's overstated by 10,000, and where did they get this number from? Beginning inventory, here they say was 20. That's 60. They sold 40, it should be 20. 20 here, bought 50, 70. Ending inventory is 10. I think they're saying that I'm not sure where the mistake is. It's very unclear. But eventually it will, in the third period, it will reverse itself. I'm looking at this and what? Okay. Without looking at the numbers, this is how it works. Cost of goods sold is understated for period 1, ending inventory is understated. Gross profit and net income are overstated and ending inventory is understated. And in period 2, it kind of flips. And then in the third one, it straightens itself out. He's squeaking something. And this is just your last slide that gives you your decision guidelines for which inventory system to use, which costing system to use as well. And I'm pretty sure that's the last slide. We're finished with chapter 6. Yay, I'll go back. Anybody questions?
No,
okay.
not
A
here.
lot of the last stuff is just kind of, you should know about it, but don't worry too much about actually doing it.
I do kind of have a question, but it's only sort of related to my or not. No, that's my cat. Sorry. The project you have up till chapter 5.
Yeah. My example.
Are you going to be putting up examples for the others?
Yeah, I just have to get to it.
Okay. Okay.
My plan for today is I'm going to go eat lunch and then take Maverick for a walk, and then Maverick has his own Facebook page. It's Maverick Puppy that you can follow without being my friend, and because I don't know about y'all, but I am so heartily sick of all of the posts about this stupid virus. And yes, we know we're supposed to stay home. We know. Okay? Stop telling me. So Maverick and I are going to start doing tricks, and we really suck at tricks. So I'm going to videotape us doing some training this afternoon and post it on his page so people can laugh at us. And then he'll probably go downstairs and play a while. And I know y'all don't care, but I'm telling you. And then I go up into the craft room with the computer and I actually get some work done. So I'm hoping to get the rest of that part up. I've got it pretty much done. I just need to get it uploaded and to do the other part of the tutorial as well this weekend. So yeah, I should be getting it up there fairly soon. Okay, watch for it.
All right, cool. Thank
You're
you.
welcome. Yeah, I've been meaning to do it, and I just it comes down on the list after a while. Alrighty, anybody got any questions? I'm not going to shut this down quite this moment, because we got like 10 more minutes.
I have a question about the test.
Okay.
Are you gonna make a study guide for it, like the other one?
This weekend.
Okay. And when is it again?
I'm probably going to open it Wednesday. I don't want to.
And do we have to do it on Wednesday
No.
if we don't have time to do
No,
it?
it'll be open for a few days.
Okay. All right, cool. Thank you.
Right. Yeah, because I know it's different doing it this way than it is doing it if I said to you, come into class and do it. But I can't see us sitting here for 2 hours while everybody's trying to do that. You know, that's kind of a waste to me when you can I can put it there and you can do it on your own time. It's far more convenient, and then we have class time to do other stuff. Okay.
All right,
Let me write. I'm writing down practice problems, quiz question. So I know what I'm supposed to do for chapter 6, and that'll be the plan for Monday. We'll start chapter 7.
And you also said that you were going to provide the problem for the quiz Friday or Saturday.
Yeah, I just wrote that down.
Cat, I swear.
I just wrote that down. That I'm going to do that.
Oh no. I thought you wrote down the just practice problem, not quiz problem.
I did. I wrote down practice problems, quiz question, project, example, and
all right, cool.
Exam, review, tutorial, next part. I kind of like to do that before I tape it, because then I don't look like so much of an idiot. Although I probably still look like an idiot at times. Anything else I need to do? I need to upload the exam. That would be a good thing. For all 3 classes. Okay, I think that's all I need to do. So what you guys need to do is, I'm not sure what the date of your homework is, and I did change the dates on the drop boxes for your project.
Oh, really? It still says overdue for me.
Does it? I thought I did.
Yeah.
Yeah, don't worry about it, but I thought I did change dates on Dropbox.
Yeah, it says overdue March 22nd.
Yeah, it was probably meant to be due then. All right, I'm going to stop sharing that, and I'll go into my D2L, if it'll let me. And I'll change those. Where did you go? I lost you. There you are. Oh, here you are. This one's you. Okay. I'm fixing it right now.
All right.
Oh, no. It says April 6th. Chapter 5 was March 22nd. I'll fix that one.
Oh, okay.
Yeah, chapter 5. I'll change that one. After that, they're all fixed.
Okay, all right.
I'm fixing it right now. Just so it doesn't. Oh, let's see. I'll make it April 4th. Okay. The reason for the due dates, pretty much, and y'all know I'm flexible about them, but The reason for that is because I've literally had students try to turn in the whole project the last week. And so I can then say, nah, you've, you had these due dates and you missed them all because I ain't grading that whole thing the last week of classes.
Yeah, that's fair enough.
Yeah, and that's pretty much why the dates are there. Yeah, literally, I've had it more than once. And that it says it in your syllabus as well. Do not attempt to submit this all last week. I will not grade it because there's always a couple that are going to try it. Alrighty, everybody. If you don't have any questions, I'll see you Monday. And again, if you need if you need me, holler and we'll set up a private session. Okay. Alrighty. Have a good weekend.
You too.
I'll try. Everybody's leaving and then
See ya.
you're getting big. Oh, Jay Lee, I did your updated your project.
Okay.
I love you, Ash.
I love you too.
And Jemima's the last one. And Jay Lee.
I'm still here.
I know. You're always the last one to go.
Yeah, I wasn't feeling too well today, so yeah.
You better?
I think I'll be okay, yeah.
Okay.
All right, bye-bye.
Bye-bye.
Thank
I hope you feel better.
Thank you.
Bye.